The best way to get good at investing is just to do it. So today, we're going to skip the theory and get our hands dirty. We're going to break down a real company, Webster Financial, you'll find it under the ticker WBS, and build a simple framework you can use for any stock you look at.
All right, let's jump right in. Here's the roadmap. First, we'll figure out what Webster actually is. Then we'll uncover its competitive edge, or its moat. After that, we'll dive into the numbers to see if it's priced right. And you'll want to stick around for the big twist, a huge acquisition that changes the whole story. Finally, we'll wrap up with what you can take away from all this, and of course, a quick disclaimer.
Okay, so step one for analyzing any company is always the same. What does this company actually do, right? How does Webster Financial make money? Well, at its heart, a bank's business model is pretty simple. Think about it. They take your deposits, your savings, your checking account, and they pay you a little bit of interest. Then they turn around and lend that money out to other people and businesses at a much higher interest rate. That gap, that difference between what they pay and what they earn, is called the spread, and that's where they make most of their money.
So Webster's business really stands on three legs. You've got your standard commercial banking and consumer banking, pretty much what you'd expect, focused in the Northeast. But then there's the third one, HSA Bank. This is a national powerhouse for health savings accounts, and trust me, we're gonna come back to this, because this is their secret weapon.
Okay, so now we know what they do, but here's the billion-dollar question for any investor. In a world full of banks that all look kind of the same, what makes Webster special? What's their edge?
Every truly great investment has what Warren Buffett famously calls a moat, some kind of durable competitive advantage that keeps the competition out. But building a moat for a bank, that's really, really tough. So how on earth has Webster managed to pull it off? A huge part of the answer is right here in this number. $13.5 billion. That is the massive pile of cash held in their HSA Bank division. And believe me, these are not just any old deposits.
This is what it all comes down to. The foundation of their moat is that HSA money. They call these deposits sticky. Why? Because they're tied to people's health insurance and their jobs. People don't just pull this money out on a whim. This gives Webster a gigantic, super cheap, and really stable pool of cash to lend out. When you pair that with their expertise in commercial lending and their strong brand in the Northeast, well, you've got yourself a pretty formidable fortress. So, we get the business model, and we've found the moat. Now it's time to talk numbers. Is the stock actually a good deal? Is it priced fairly, or could it be a bargain? Let's take a look. A classic place to start is the price-to-earnings ratio, or PE. And right away, you see Webster's PE of 11.3 is basically right in line with the industry average. But here's the interesting part. Look at its closest competitors, its peers. They're trading at an average of 12.6. So Webster is actually trading at a slight discount to them. It's like the market isn't giving them any extra points for that awesome moat we just talked about. Now, this is where it gets really fun. That PE ratio, it only tells part of the story. This number, 0.2, this is their PEG ratio, and it tells a very different story.
So what is a PEG ratio? It's simple, really. It takes the PE ratio and divides it by the company's expected earnings growth rate. The rule of thumb is that anything under 1.0 might be undervalued. Webster's PEG is 0.2. That is incredibly low. It's basically a flashing light suggesting that the market is seriously underestimating how fast this company is expected to grow its profits out to 2027.
But just when you think you've got it all figured out, you've got a solid company, a great moat, and what looks like an undervalued stock, something happens that just flips the whole chessboard over.
And here it is. In February of 2026, the story takes a massive turn. The global banking giant Banco Santander announces they're buying Webster in a deal worth over $12 billion. This isn't just a small plot twist. This fundamentally changes the entire investment case we've been building. I mean, just look at the before and after here. On one side, you have Webster as a really strong regional player. On the other side, it becomes a crucial part of a massive global financial group. For Webster, this means access to way more resources and scale. And for Santander, well, it's a genius move. They get to use Webster's super cheap and stable deposit base to fund their own high-profit consumer loans here in the US. And if you look at it from Santander's side, this is a huge strategic victory. They're making a massive bet on American banking, and they expect this deal to immediately boost their earnings per share by about 7 to 8%.
they're predicting a really healthy 15% return on their investment. It's a win-win.
So, we've gone through the whole story. What's the big takeaway here? What can you, as an investor trying to figure all this out, actually apply from this case study? It really boils down to this simple 3-step checklist. First, you have to understand the business. How do they make money? For Webster, it was their banking segments, especially that HSA division. Second, you have to identify the moat. What's their unique edge? For Webster, it was that huge pool of sticky, low-cost deposits. And third, you have to see the big picture. Are there any massive events, like this merger, that could rewrite the entire story? That's the process. Find a great business, understand why it's great, and always keep an eye out for those game-changing events. And finally, before we sign off, just a very quick but very important note. Please remember that this whole breakdown is for educational purposes only. We're learning a process here. This should not be taken as financial advice to buy, sell, or do anything. Every investment has risks, and it is absolutely crucial that you do your own homework and talk to a qualified financial professional before making any investment decisions.